Cool. Okay. Hi, everybody. This is March the 12th, and this episode number 13 of the physics of Bitcoin with Giovanni and Stephen. And as always, I'm going to introduce a little bit to the show. Both of us have physics PhD, in particular in astrophysics, and we are also interested in Bitcoin. So it's natural for us to apply ideas from physics to this topic. Basically, we are trying to avoid methods that other people use, like the traditional TA methods that usually don't work, and we are treating Bitcoin as it was any other scientific data. So we are applying all kinds of different tools from signal processing, statistical tools, and to try to understand both the statistical properties, but also the dynamics of Bitcoin, and comparing past patterns with present patterns and trying to make sense of Bitcoin behavior that, according to our study and our experience, is quite different from other assets. So this is our particular angle. Anyway, Stephen has an agenda that is going to share with us.
Okay. Hello, everyone. Thank you for joining. Okay, let's go into slide mode. All right. So just before I get to the agenda, in the upper right is the mathematical expression of the topic that we're going to cover today. I've called it Bitcoin for every moment, but what it is the higher moment analysis. So you've probably heard the term skew, and you may have heard the term kurtosis. Those are higher moments. If you think about variance and standard deviation, those are the second moments. So if you take residuals and raise them to Q of 2, then you get the variance, and the square root of that is the standard deviation. Well, you can raise it to higher moments, 3, 4, 5, and 6. And that's what we're going to explore today. Now, typically, this is done by taking the series of percentage changes or really log normal changes from one time step to the next, from one day to the next, if you're using daily data. Now, the chart in the lower right is our distribution of residuals, not in that form, but after you take a power law out. And that makes a lot of difference, as we're going to see. So let's move to the agenda. Okay, it's about higher moments, and the names for those are skew and kurtosis, and hyperskew and hyperkurtosis. And they're also called the third, fourth, fifth, and sixth moments of a financial price series. Now, the stock market skews left, and it has positive kurtosis, and neither of those is desirable from a risk management standpoint. I'm going to show you a couple of research papers that, I've put the adjective pedestrian in front of them because they look at Bitcoin, they calculate the skew, and then they throw it in the trash. They don't use it. And they use the traditional sharp analysis that only uses the second moment, the variance or the standard deviation. So the first thing that you want to think about doing is adding skew and kurtosis. And this is a well-known procedure. It has an acronym, MVSK, which means mean and variance and skew and kurtosis for optimization. It's an extension of Markowitz mean variance modeling. Now, the Bitcoin skew and kurtosis that I will show you move around a lot depending on sampling time step. And actually, these research papers, they looked at the same data set, but they couldn't agree what the skew and kurtosis were. So that was interesting, too. When I apply the usual method to a much longer time series, really the full price history, they used a truncated price history, then I find that the third through sixth moments are quite large. The skew up through the hyperkurtosis are quite large. But the with daily time steps, the values are pretty consistent over long stretches of time, and they do gradually change. They tend to increase with time, but it's a fairly flat trend in the longer stretches of the history. But very important, then what we do is we detrend with the power law. And what we find is that the moments are drastically smaller. In fact, they're almost smaller by the square root of the moments that you find with the usual method. I then go on and apply this to MicroStrategy and a comparison of MicroStrategy and Bitcoin, and the same method of looking at the higher moments and detrending with the power law, and then evaluate. And you have to make a decision about how much you weight skew and how much you weight kurtosis. Those are the only moments that are used. And it actually shows that in a Bitcoin versus master decision, you should be 100% Bitcoin. Now, that's a little controversial. There are other ways that you can analyze that'll give you different answers. But that's what this method shows. And with Bitcoin against the S&P 500, again, you end up with 100% Bitcoin, which is very different from what you see if you use the usual analysis that you find from many traditional finance sources that just look at the Sharpe ratios. And again, those are only the second moment. So for traditional assets, stock market has negative skew, which means downside risk to crashes. It means that your left tails are bigger than your right tails. And of course, it's got long-term trend exponential growth, not power law growth. So the combination of negative skewness and high kurtosis is a higher likelihood of extreme negative returns and necessitating cautious risk management. And it's somewhat similar for NASDAQ, for the triple Qs. Gold has some positive skew, and so that's why it's often been used as an asset for hedging a portfolio.
Interesting.
Yeah. Okay, now here are a couple of traditional sources on the S&P 500 over long periods of time. And these are time frames. In the first case, that's 50 years. And in the second case, ran for 20 years. They find different values, but they both find a negative skew. In the first case, minus 0.6. In the second case, minus 2.4. And they both find rather high kurtosis. In the first case, 21 for daily returns and 54 for the data in that 20-year period. However, if you exclude that 1987 crash, the kurtosis is much smaller. It's 6.8. So that's the traditional stuff. And now here are two papers recently published that looked at Bitcoin, but ended up being very traditional in their approach. The first one is by, I don't know if this is a male or female name, but a Mr. and Ms. Zhu from University of Manchester. Ultimately, they only consider volatility. They measured skew, but then they threw it away. This shows their measurements on the next page. So they used a period of data, daily data running from October 2017 to January 2023. And they published this last year. And they find a Sharpe ratio of 0.71, which is higher than you see for SPY or for the triple Qs. Of course, much higher return and also much higher volatility. And much higher maximum drawdowns, we know that. Their skewness is slightly positive. Their kurtosis is 2.66. Now, Gaussians have kurtosis of 3. So actually that kurtosis is more narrow than the, Gaussian or normal distribution. The SPY has a higher kurtosis, negative skew, and the Q has negative skew, but its kurtosis is not as high. And this one, so they go through all their analysis. They have a lot of text about, the risks of Bitcoin, this exchange crashed and this hack happened, etc., that are sort of irrelevant to doing a numerical analysis. And then their conclusion is allocate less than 20% to Bitcoin. And I'm going to show you why that's wrong if you actually incorporate skew and kurtosis and if you detrend with the power law. Now, here's another Zhu, but it's spelled XU, and from a different place, from Vanderbilt University. And they do the same thing. And it's very curious because their price data runs from October 2017 to January 2023. It's the same time period as the other paper. And their analysis is of 4 assets: gold, SPY, DXY, and the Qs, in addition to Bitcoin. And those are exactly the assets in the other paper. So I don't know if these people know each other or what, but they were using the same data set and looking at the same kind of high-level ETF assets. Now, what was interesting about this one is that he looked at all the different time frames. So he looked at annual, monthly, weekly, daily, hourly, all the way down to minutely. You know, I think that's one of the reasons why they're using the same data set, because they had the availability of very fine-grained data. So that part's good. And another thing you're going to notice is, this is all for Bitcoin, that, you know, the skewness and kurtosis vary dramatically as you change your timestamp. And when you reach annual, then it goes negative, and even the kurtosis goes negative. But you have a very, very limited data set. You don't have very many data points. But the Sharpe ratio is the highest in that case, as we would expect, you know, from our own experience. If we look at the daily, the skewness is moderate at 0.3, the kurtosis is high at 6, and the Sharpe ratio that he finds is moderate. But the other paper, using the same data daily, he claimed his Sharpe ratio was 0.71. So I don't know what's going on there. Somebody has treated the data in an inconsistent fashion. And the other paper found, you know, a kurtosis that was less than half that, presumably on essentially the same data set. So they throw away the higher moments. They end up doing a Sharpe comparison with gold, with the Qs, with SPY, and with DXY, which is just dollars, the dollar index. And they initially get a 4% allocation to Bitcoin. And then they say, well, what if that's not very much? What if we threw the Bitcoin away? I can get the same risk reward without Bitcoin. And so their final result is 37% in fiat cash and no Bitcoin, as shown in this table in the lower right. And, you know, that gets them a monthly weighted return of 0.25%. Now, right now on the power law trend, Bitcoin has a monthly weighted return of 3%. So, you know, it shows you that
something is wrong. Yeah,
they're driving with the blinders on. Well, what's wrong is that they haven't detrended with the power law. They've just taken day-to-day variations, and you know they use the R for that is the residual, is the log of the variation, so just the log of the ratio, you know, of the day 2 price over the day 1 price. And they threw away skew and they threw away kurtosis, even though Bitcoin is favorable on those, certainly on the daily time frame. Okay, now here's somebody on Twitter responded to me with something, and it's partially relevant. They said that they were able to get, using Sharpe analysis, a higher value. So if you take a generic Sharpe analysis, you end up comparing only to the S&P 500 with a 29% weight for Bitcoin. So using the volatility and the variance and the expected return. Now he's familiar with the power law, so he changed the volatility and the variance to reflect current power law expectations. And that he plugged in expected return of 0.43% per year, which is what you get roughly with the power law. And he put in a volatility which is lower than the full history because volatility has been coming down. And with those, he ends up with a weight of 0.48 rather than 0.29. So that gives you some hint of what you can do if you start thinking about the power law, but this does not actually detrend a price series with the power law, and it does not include the skew or the kurtosis in any explicit way. But still, it's an interesting jump that you get an allocation. Okay, these are my results, and I'm starting from the long time frames first, the monthly and the yearly. And in the spreadsheet, in the top, we have the monthly results. And in the bottom, we have the yearly results. And I'm actually showing you all the details for the yearly numbers. And you can just do this in a spreadsheet, but it's a little more work. You end up coding if you want to do, daily and weekly. It's too much trouble for a spreadsheet for most people. So what you see is for monthly, you can read the standard deviation, the variance, the skew, the kurtosis, the hyperskew, and the hyperkurtosis. These are normalized. So these are normalized to the standard deviation raised to the Q power, where Q is the moment in question. So it's 2 for the variance, it's 3 for the skew, 4 for the kurtosis, etc. And so then in those units, or with that normalization, the variance is always 1. So then you're interested in skew, kurtosis, and the higher moments relative, in relative terms to the variance. So the equation is just the mean over your price series of all of these residuals from one time step to the next, with each residual raised to the Q moment power, and then all normalized by standard deviation of Q. So that's how that's calculated. So in the table with the big font, I've summarized one of those 2 research papers, the one that had the monthly data, and what I find. So on the top, we have skew. They found with 5 years of data, 1.3. I found with, 15 years of data, 0.9. And that's at the monthly time frame. They found a negative 0.6 on the annual, but they've only got 5 years. So the statistical accuracy is not great there. And I find minus 0.08. For the kurtosis, with 5 years data, they found 1.5. I find 6.6. And that's at the monthly scale, but it's quite different at the annual scale. They find minus 2. Again, that's a noisy number, and I find 1.8. Still noisy, but better statistics than they had. Okay, and this is more a description about how you interpret those. So if you go down to the skewness line in the table, the monthly data shows strong right skew, but the annual data is almost symmetric. It's slightly negative. The kurtosis is much higher with the monthly than it is with the annual, which suggests extreme events are more likely at shorter time frames. We know that things get smoothed out when you get to annual time frames. And similarly for hyperskew, where you're showing huge tail asymmetry with right skewed extreme moves, and again, a high number for hyperkurtosis for the 6th moment with the monthly value, but much lower with the annual value. Now, it's important to note that only the 3rd and 5th moments can be negative, because you're raising this thing to a power. So if it's a square, 4th, or 6th, it's always going to be positive. If it's the 3rd power, it can sometimes be negative, or the 5th power. So Bitcoin's right skewed returns, particularly for the monthly and the daily, suggest asymmetric upside potential. Positive skew is good. Now this is the same process repeated at the weekly time frames and the daily time frames, the normalized moments. And what we see is that we get higher values than the monthly for the weekly, and the daily is even higher than that. But everything's positive with the daily. So looking at the weekly, the skewness is negative 0.52, the kurtosis 12.8. But if we go over to the daily, the skew is positive 3.8, and that's good. And the kurtosis is 25.5, and that's less good. But these are not power law detrended. And if you go up to the 6 moments, then those get very, very high, 2,400 in the case of the daily. This is a plot of what those look like if you just take part of the data set and then add, another year and another year. And So it's the cumulative values for the higher moments, the third through sixth moment, starting from a few years of data all the way up to the full 15 years or so. And you see that they move around a bit, but the lines are relatively flat. It's logarithmic on the y-axis. So those are some significant moves of like 0.3 in the log. And in the case of the sixth moment, 0.5 in the log. They do tend to flatten out once you reach 2018 to 2020. Again, these are not power law detrended, so these are large values. Now let's move on to power law detrending, because this is where the magic happens. So the first thing I do is just a quantile regression, as we've often done before. And you see the equation there for that. It's a 5.87 power. This is the median of the quantile regression, 0.95 r squared. And now you see the values are much, much lower. The skewness is 1.9, the kurtosis 5.4. These are daily. The fifth moment is now 15 instead of something that was several hundred or well over 100. And then the sixth moment is 46 instead of over 2,000. So I've shown that in the histogram. That's a logarithmic axis for the y-axis. So it's the moment value for each of these higher moments. And you can see it makes a very large difference. It dropped from, I show in the inset, the small white background. It dropped from 2,407 down to 46 for the sixth moment. It dropped from 229 down to 15 for the fifth moment. 25 down to 5, 3.8 down to 1.9. So you can see it's almost kind of a square root scale down. And what this is telling us is that if you looked at the actual underlying reality and detrend with the power law, that it's better behaved than you would assume using traditional techniques.
Right.
I just went the wrong way. Okay, this is just more explanation on those. This is actually ChatGPT's interpretation of what we're seeing. If you look down at the bottom, basically saying that the raw data set appears more favorable for extreme upside, but significantly higher risk. The detrended data set shows a more stable investment environment, fewer extreme gains, also fewer crashes. So it gives us more confidence in how Bitcoin is behaving long-term, because the kurtosis is very much lower. The skewness is lower. It's half of what it would be otherwise. And so that's less upside, but we know that the gains are gradually coming down as well as a consequence of the power. So that is somehow being reflected in all of these higher moments. Okay, let's now look at MicroStrategy. First, we look at the not power law detrended results. And again, we find very high numbers. The weeklies on the left, the dailies on the right. No, I'm sorry. Scratch that. On the left, we have the entire history of MicroStrategy since nearly that entire history, since the beginning of 2000. And on the right, we have only the history since Saylor adopted the Bitcoin strategy in August of 2020. 4.5 years. So we care more about what's on the right. But if you look at what's on the left first, nearly the full history, you find very, very high fourth, fifth, and sixth moments. If you look on the right, the post-Bitcoin strategy version of MicroStrategy, the skew and kurtosis are down considerably. The skew goes to 0, and the kurtosis drops by more than a factor of 4. The fifth moment goes slightly negative, and the sixth moment is way down. And in fact, the kurtosis is quite close to 3, which is sort of a normal value. And that was the weekly. These are the daily. This is just the daily since August 2020 when the Bitcoin strategy was adopted. And we have skewness is slightly negative at minus 0.1. We have kurtosis, fairly heavy tails at 6, but lower than Bitcoin's. And the fifth moment is quite negative, minus 6.7. So that's kind of a warning bell there. But if we then look at the weeklies on those, then they're lower values. Well, this is just the comparison of the previous slide, where only the fifth moment is negative and the skewness is flat. Now we power law detrend the daily. So the previous was not power law detrended for either the time frame and for either time step, weekly or daily. Now this is daily only since August of 2020, so only with the Bitcoin strategy, and now power law detrended. And here the power law is 7.3 slope. Very importantly, you have to base it on the Bitcoin age because he's basically just jumped on the Bitcoin rocket, right? So we have to zero it to the January 3rd, 2009. The R squared is modest at 0.42. I mean, we know it's a very noisy series. We know that, he had a lot less Bitcoin proportionally than he does now. He wasn't 100% Bitcoin early on relative to his market cap as he is now. So if you look at now this power law detrended moments, the skewness is close to 0. The kurtosis is 1.9, less than 2, which is less than the normal distribution of 3. The fifth moment is modest. The sixth moment is reasonably modest. And there's no advantage of negative skew here that we have with daily Bitcoin. So the next thing we can do is we can use those values and plug into an optimizer. And the formula for the optimizer is shown below the chart. It includes the portfolio return, which is normalized to the portfolio's standard deviation. You're trying to minimize, optimize a function by finding the minimum. So you subtract out the portfolio return because you're trying to find the minimum of this function, of this space. And a positive skew is a good thing. So that also has a negative sign in front of it. But a positive kurtosis is a bad thing. So that has a positive sign in the optimization function. So in the current optimization, positive skew favored, kurtosis, the fourth moment, is penalized. And we do not include the higher moments. And then the next thing you have to do is you have to apply a weighting to the skew and the kurtosis. And the weights that we've used relative to the weighting for the standard deviation, which definitionally is 1, we use a weight of 0.2 for the skew and 0.1 for the kurtosis. And then you run that through this optimizer function, and the result is 100% Bitcoin. And what's plotted is an efficient frontier that shows master in the lower right. And with that, you have a higher standard deviation, and you have a skewness close to 0, right? So if you had a pure master portfolio, your standard deviation would be higher at 0.32. Your skewness would be almost 0. With a fully Bitcoin portfolio in the upper left, your standard deviation is lower at 0.24, and your skewness is higher. So those are both favorable. Now, this doesn't show you return. Your expected return is not quite as high, right? Because the power law is 5.8 instead of 7.3.
Right.
But when you kind of fold it through the risk analysis,
yes,
it says that you're better off fully in Bitcoin. Now,
that makes sense because you're paying a premium for getting that leverage from. You could not have leverage and less risk, right? It makes complete sense.
It hasn't been worth the extra risk, is what this is saying.
Yeah.
To date. Now, I had a couple of provisos. One is if you do a Kelly optimization, depending on what time frame you use, like monthly or quarterly, you could end up with 20 to 30% master in your portfolio under the Kelly criteria.
Right.
And also, we're not fully accounting for the fact that he's built up now over time this 500,000 Bitcoin pile, right? That early on he didn't have. He had a very small pile.
Yeah.
Plus, we only have a 4.5-year price history. So, this may not project going forward.
True.
But based on history, that's what you have to conclude. Now, another thing that we should
Is
worth noting.
I beat 1-to-1 with Bitcoin always, or there is a chance that there is some different behavior? Also because I beat is traded only 5 days a week. Would be interesting to do it. How do you account for that, by the way? The fact that MicroStrategy is traded only 5 days a week.
Yeah. You're only, it's not explicitly accounted for here.
Yeah.
Because you're just feeding return, standard deviation, skew, kurtosis, and some weightings, right?
Right.
After having first massaged the daily data that you do have 5 days a week in order to determine those parameters. So it's implicitly there, but it's not explicitly in this optimization analysis. Okay, let's move on to comparison to the S&P 500. And first, we need to note that Bitcoin's volatility has come down drastically. Now, this is the rolling volatility. So this is all volatility up into the year 2014, and then up until 2016, and then up until the present. So the cumulative volatility has fallen from 0.08 to under 0.05. So that means in recent years, the volatility has been even lower, right? Because it's been dragging the average down. It's been in that 0.03 to 0.04 range. That's daily. This is daily volatility. So, right now it's like 3 to 4% per day volatility. That's what this corresponds to. This is just the log of variation, which, so it's just e to the x, e to the 0.04 per day, which is 4%, essentially 4%. Okay, so we repeat the same exercise now, instead of with master, with the S&P 500. And because volatility has come down so much, I'm not using the whole historical data set for the comparison to, I am for the parameters for the S&P. I'm using the long-term stock market variance, skew, and kurtosis from that 20-year period that other study did. But I'm not using it for Bitcoin because the volatility has come down so much. So I ended up using the same data set as I used in the comparison to master. So it's about a 4.5-year data set that reflects the lower volatility. And then the appropriate, skew and kurtosis. And you feed it through the optimizer with the same weights, and you end up with 100% Bitcoin. Now we can go look on the slide and we can see, how you interpret that. The log 10 return increases from 0.04 in the lower left, which would be a pure stock portfolio, up to 0.16 in the upper right, expected daily return, with a pure Bitcoin portfolio. So the log 10 return, this is the log 10 return, I think, goes up by a factor of 4 along the curve, and the risk is up about 50% because the standard deviation has gone from 0.16 to 0.24. And the skew starts out, it's color coded here. So it's blue, if you start out in the lower left, is -2 something with stocks. And then as you add more and more Bitcoin, you move up that curve, and the skew flips to positive and becomes quite large. Noticeably, it's 1.6 or 1.7. you can apply the same thing against cash, and you'll get 100% Bitcoin. Now, what I haven't done yet is play around too much with these weights. We can adjust those, and maybe I'll do this in the future and see, what it would take to change from 100% allocation to Bitcoin and build up a matrix. But those are fairly reasonable weights to adopt as initial guesses. Okay, so summarizing, analyzing the higher moments of Bitcoin and always keeping the power law in mind. The moment analysis for the stock market is negative skew. For Bitcoin, is very steep before you detrend with the power law. If you use just the traditional daily variations, etc. But we know the market exhibits clear power law behavior with heavy tails, and the actual residual analysis daily and the higher moments that you measure actually get interpreted as indicating this power law behavior. So large high moments are a feature. Sharp-based analysis throws away all the higher moments. Bitcoin is sometimes positive skew, sometimes positive for the fifth moment, the hyper skew. It does vary a lot depending on the price interval analyzed. But we settle on the daily because we want to have a lot of data. The monthly skew and kurtosis are much higher than with annual data, so that suggests extreme events on the shorter time frame. The daily third moment, the skew and the fifth are positive, and that's quite favorable, and they remain positive after you detrend with the power law. All of the moments are much smaller after power law detrending, and so your stability is higher than you would have thought using traditional moment analysis techniques. For master, since August 2020, detrending has a noticeable effect on the higher moments, but small effect if it's just the daily series. And then running through a portfolio optimizer, master versus Bitcoin, you end up actually with 100% Bitcoin because of the lower risk profile. And not surprisingly, I think to most of this audience, Bitcoin versus the S&P 500. Again, I use since August 2020 because volatility has come down by a factor of 2 or more. You get Bitcoin 100%.
Fantastic.
And we've got this nice slide from Michael Saylor's recent talk in DC, Digital Capital is a Moral Capital. So he's got Bitcoin out there pegged at 1,000 year time frame, whereas we know companies last about 10 years on average, and cities and countries maybe hundreds of years,
Right.
certainly in the imperial phase. So Bitcoin's built for the millennium.
Yeah.
All right.
I love this result. It's nice result. Again, it shows how it's important to subtract the trend, because once you subtract it, then you see that you still get the general growth, but the deviations are actually in your favor, So it's really good. Yeah, again, it's a very publishable result. I like it, and given that other people have published other things with not coherent results and very different.
I mean, those are published in financial journals, right? And it's sad.
It is sad.
Yeah.
Thank you. Okay, so I'm going to cover somehow related but the different topic. I'm going to talk about liquidity. So I want to go deeper and deeper in the liquidity topic. And I already done some work in the past. But right now I wanted to explore this topic. So there is some, so what you're seeing here are my trading view indicators. So first of all, you see the Bitcoin price, you see SPY. Many people say, oh, there is a correlation between the stock market and Bitcoin, yeah, up to a point, because if you look at the long-term trend, you can see that SPY, for example, and this applies for everything, all the different stocks, Nasdaq, etc. There are no power laws. Sometimes Fred Krueger was claiming that there are power laws in some of the tech stock, but it's a misunderstanding. There is such a thing called a stretch exponential. And the stretch exponential, if you're not careful, if you plot it in a graph like this, it looks like a power law, but it's not a power law. It's a stretch exponential, and you can show it. So this one, it's a clear exponential because it looks like a straight line. You can really fit a straight line through here, and you can see that when you have in a log linear chart straight line, then it is an exponential. Now, sometimes exponential can be, you will see a very nice exponential for some time when there is a steeper exponential. There is it's not necessarily one single exponential, but for the majority of the path, it's an exponential. And Bitcoin is not, right? You see how it's curving. It means it's something else. You get a straight line when you take a log of the x and of the y-axis. But of course, financial markets are strongly correlated, at least locally. So there is some correlation, even visually. Now, the other question is there a correlation with global liquidity, right? And there are many different measures of global liquidity. I have another indicator where I have a more sophisticated measure, where I take more parameters, but here I'm just taking M2, this global M2, this yellow quantity here. And again, visually, it does seems there is some correlation. Now, there has been recently a claim that if you shifted the M2, then your match with the price is even better. And this is why I wrote a code where I can try different shifting. So the one suggested was 10 weeks, right? So this was one of the claims that if you shift the global liquidity by 10 weeks, then you get almost a perfect match. And you can see what we are talking about. We are talking, let me suppress SPY so it's easy to see. We are saying this, we are claiming this, right? We're saying, oh, look, it's basically starting almost 1 year ago, more than 1 year ago. We see this component matching, then this one. But my criticism of that, let me see if I can make it a little bit bigger. Okay. My criticism of that is, you see how the price is actually going down and the liquidity is going up, right? So they are not changing much, so they kind of look similar, but clearly one is going up and the other one is going down. So, okay, and they kind of cover a same period, but during that period, one was going up and the other one was going down. So I don't know why people will make that claim that they match. There are things happening in the market that influence almost everything. And so, see if I can stretch it even more. So, yeah, you will expect that there are some turning points, some events that are happening more or less at the same time, but we have different impact, right? Liquidity was going up here, the price was going down. Now, here, some other turning point, the liquidity was going up, price was going up, price went even faster up. And then, okay, it reached a peak here, but it stays stable here while the liquidity went down. So, and then why only 1 year, right? If I look at other places, well, okay, you can say, well, sure, maybe it was some matching here, but then you can get a better matching if you use 11 weeks, to try to match this component, right? If I go back and use 11 weeks, now I can match all of a sudden this component. So I don't know, maybe periodically there are some correspondences with a certain lag, but then if you play this game of matching pattern by using something arbitrary like a lag, and the lag can be 10, 8, 9, I started not to follow anymore, right? There are more scientific way of doing this. So for example, you can calculate cross correlation. Now you can do cross correlation over the entire history. You can do it over short amount of time. I didn't do like for let's say, for example, 1 year. It would be interesting to try 1 year and show if these 10 or maybe 2 years, and show that maybe these 10 weeks delay gives you a better match. But I didn't do that yet. What I did, because I'm playing around and I'm testing things, but I'm going to share my slides now. Just a second. And hopefully I can make them larger. People always complain about that. I'm going in presentation mode. I don't know if it helps. I don't know why I don't get the same result you get. Presentation mode. Slideshow from current slide. Does it make it bigger? I think it's bigger this time, right? It looks bigger.
It's okay.
It's okay. All right. So this is a mathematical tool called cross correlation, where you basically calculate a correlation at a given lag. If it was a lag that gave you a better correlation than zero lag, it will look like another peak, several peaks. It doesn't look like that, right? It simply looks like the best correlation that you get. And it's pretty high correlation, but it's when there is no lag at all. Do you agree with that?
That's what I see, but that scale is pretty large. That's 1,000. So what happens if you drill down?
If you draw down, what do you mean?
I mean, how close to zero is that? Is it 10 or is it 50?
We can check. We can check. Yeah. It's pretty close to zero, but we can double check.
This is days, right?
Yes, days. This represents days. So I can zoom in the original picture. I did double check if I got anything like 70, but 70 days. But it's just a second. I'm trying to zoom in. I see what you're saying. You're saying is that peak is not exactly at zero, just by roughly.
The interesting part is the asymmetry. So
yeah, how do you interpret the asymmetry?
Which way is the sign on the lag here?
Just a second. Yeah, the peak is pretty much close to zero. Yeah, it is at zero. Zero. Yeah, I'm zooming in more and more. I zoom, and yeah, it's basically zero. It's basically I'm taking the cross correlation of, and I can do it both direction, but right now I did it. It's price cross correlated with liquidity. So I imagine that we are shifting.
So price is lagging liquidity to the extent that we have a big right shoulder, yes?
Yes. But how will you guess what is the total lag? I know that is
well, you need to fit that with a distribution that's more symmetrical, right? That's why he's seeing it, because it has this big right shoulder. So what if you tried to put a Gaussian or a gamma distribution through here? Then where would the peak be? It would be shifted.
Gamma distribution. Tell me again. Explain me this.
Yeah, well, if you put a distribution through this data, the peak won't be at 0. If you put a mathematical model through here, the peak will be shifted right. And that's why they're measuring a lag, because you have this big right shoulder.
Well, I was expecting a peak in the cross correlation.
Yeah, it's a messy peak.
It's a
smeared out peak, right? And so it manifests as this right shoulder, this asymmetry with this right shoulder. So if you ran a Gaussian through there, where would the Gaussian be centered? And how wide would it be?
A Gaussian around the model. So you make a model and then you add a Gaussian representing the distribution of a price. Something like that. Okay. Well, we can discuss offline, and maybe you can show me because
well, there are two ways you can do it. You can run a mathematical distribution through this curve, or you can run mathematical distributions independently through the M.
Oh, I see what you're saying. You want to fit with a Gaussian, and then see where the peak is, and that will give you the delay. So why do you get this? Why do you get the shoulder? Because it's more than one lag that works. So it's not.
No, I think there's a lag, but the lag is not always 10 or 11 weeks, right? It's cleared out.
Yeah. So there are several lags, and several lags will work for different times, right? It is kind of what I was saying before, that you could play with different lags and will match a certain period, and then it would not match another one, and then you will have to use another lag. So it probably has smearing of different lags, right? But it's okay, and I understand what you're saying. It's a really interesting then. I will play with that. Maybe we can discuss offline. But this is the result I got right now. It's a preliminary result. So yes, there is an asymmetry. The asymmetry is on the right, and given that we are doing price versus liquidity, means that the price is lagging. So that is a cool interpretation of this result. Yes. Otherwise, if it was no lag at all, you will see more symmetry here, right? Okay. Well, there is still pretty strong coherence, right? Correlation at 0, I will say, right? Even so, you could still consider them without any lag at all. But we will investigate better the lag. So the next thing I did was to actually plot it one against the other. And I did that in the past. When I do it with the entire history, I don't get a power law. I get a more complicated model. In particular, when I use my more sophisticated measure of global liquidity. But even if I use M2, it does look curve if you take the entire history. So in a log graph, it doesn't look like a straight line. It looks curved. So you will have to use something, like a polynomial expansion or something. So it's a more complicated model. And this is what I do in my usual model for liquidity, for a price model based on liquidity. I use a polynomial expansion. But I remember you told me a few times that you were seeing a power law, right? Because you also tried. You were seeing a power law relationship between the price and the global liquidity, correct?
Well, I only tried a little bit, and the quality was similar to this. And this is the kind of power law that a social scientist gets very excited about, right?
Well, actually, if you get something like this, we will be super excited.
An economist gets really excited, and that's
you will get a power law of 0.5 or 6. That is.
That's why Michael is excited.
Right. But the trick is to use only partial data. So I use data, basically 1,500 days. So 4 years after 2010. So starting 2014. So around 2014. So if I look at the data from 2014 to today, then it looks like this. If I include early data, I don't get a nice power law. Even it's much more curved, and the R squared, it's terrible. But I get a decent fit if I get since 2014.
Okay, well, how about this? How about if we take out the Bitcoin bubbles and just use the lower half?
We could do that too.
Of the residuals and see if the core Bitcoin, how that.
That is a good idea. Yeah, I will follow up with that.
Yeah.
But even with that, this is the model that I get. So if I use liquidity as a predictor for the price, and then I use the parameters that I derive from the previous power laws, the slope and the y-intercept, I get this red curve as a model for the price. But it's not too bad, right? It's not too bad. You can see actually that even the peaks align somewhere, right? Now there is one interpretation of this is why there is not a perfect match with the peak is that after some time the price starts to go crazy and do its own thing. Yes, there is some kind of macroeconomic parameter that maybe influence both of them, right? The general status of the market, whatever you want to call it. But there is this running away from the model, this overpricing, this basically the skew that we are talking about, that is due to FOMO. It's mostly FOMO that brings the price.
Yeah, it's almost like the pickup in liquidity pushes it through the transition zone.
Yeah.
And it starts to enter the bubble zone. And then once it does, then the crowd herding behavior takes over and pushes the price into a log periodic parallel bubble.
Yeah, and there is a disconnection between the fundamental and the price, right? But it's good because it's above the general growth, right? Now, and the correction, it's a correction anyway from this huge growth that you had anyway, right? So if you're holding, you're not really affected too much by that, right? So it's okay. Same thing with the other cycles and so on. So we have only 2 cycles, mostly because, like I say, I excluded the early history. Now it's interesting here where actually we drop below the liquidity. So that actually it's what you will expect, that the overreaction of the market goes so far where the liquidity say, well, Bitcoin should not be undervalued like this. It's an overreaction, right? And so you're like the last bottom that we had, we were much lower than what the liquidity will have suggested. And now what you see that during the last, when the bull market started, that is basically this section where you see the price going up at around 3,500, index 3,500, the price started to go almost vertical. Again, we went there without the support of liquidity. And usually you see during the bull market, liquidity, it's preceding, right? There is an excess in liquidity. The price is below the liquidity evaluation. And then actually that is a good thing for the bull market. The bull market usually identified on this region, like you say, transition, right? So we stay below and then we go above. And that is what happened during the bull market. But this time we went above without having the liquidity being, stronger than the price itself. So there was some disconnect there. And now, there was all this period where the liquidity stayed. In fact, actually, the liquidity started to go down while the price was going up. So they were doing the opposite thing of each other. But it's something that I noticed also in my regular model. I say this is weird because the price is actually shooting up, but the liquidity doesn't support this movement. We don't have enough liquidity for that. But now notice we are correcting that. And so the liquidity is catching up with the price. And it seems actually, according to the model, they are kind of crossing, right, at this particular moment. So maybe this is a positive sign, right? So if the liquidity continues to go up, then we don't need further adjustment in price. Maybe, the price will start to catch up with the liquidity. I don't know. That is if it follows what happened before. So it's a good thing that right now they are meeting each other, because they should have done it early on, but better late than never. So that is one of my interpretation of what is going on right now with this model. I think it's a relatively good model. In general, it says, as far liquidity continues to grow worldwide, Bitcoin reacts to it, and it continues to go up. Because it's what we are talking about. There is a transfer of liquidity, of global liquidity, to Bitcoin, right? And it's going to Bitcoin, and it stays there, right? Because overall Bitcoin continues to grow in time. There are some cycles, but the overall growth is still visible. So this is where I stopped in my last preliminary results of this exploration. I like both models, the generalized model that I created, starting from the beginning. It gives you some slightly different insights, but this one is simpler for sure, because it's a simple relationship, this power law. I'm surprised. It's very interesting that the power is close to 9. So basically saying that whatever liquidity you have available, you get a power of 9 of that, right? That is incredible. Absurd. It's crazy. Yeah. So, almost 9, right? 8.7. So it's even stronger with a normal power law of 5.6. It basically, whatever liquidity is doing, it multiplies liquidity. So Bitcoin is a non-linear multiplier of liquidity. Would be interesting to do the same thing with actually with SPY, SP500, etc. I bet. In fact, I think I did it one time. I need to revisit, but it was almost like a one-to-one relationship. It was a much more linear relationship between the two. That is really interesting, because that again will make a very strong case of why it's a good idea to invest in Bitcoin, because it's a multiplier of available global liquidity. But yeah, it will be not. That is probably the next things I do. I want to do a one-to-one relationship, right? I want to compare the two and see what is that exponent. If I remember well, it's a linear relationship, but I want to revisit and make sure that is the case. Anyway, do you have any questions about this or any comment?
Yeah, I don't have further comments. Howell, I think, found over 10 for his
over 10
power law index. Yeah, so it's
but
really
he has a slightly different relation quantity, right? To calculate.
Yeah, his is incorporates like the private banking and hedge funds and shadow banks and yeah. So it's actually a broader measure that doesn't look just at central banks, but looks at more deeply in the banking system as a whole. Yeah. But anyway, either way, it's very steep. Yeah,
it is steep. Yeah, but anyway, we have relatively close value, right? 10 and 8.7. Okay, so we can look at questions. So in fact, we have this one, Michael Howell, you started getting worried about liquidity. Well, I'm just showing that liquidity actually is going up. So I'm not sure he has a different measure of liquidity. So I'm not. I need to see that episode. I usually try to follow him. I'm subscribed to his newsletter, so I don't remember these statements about him being worried. I was worried myself when he was going down, but recently, like in the last month or so, he's going up. So maybe now he's not worried anymore. But again, I'm looking at M2 or other similar measures, and he's looking at slightly different measure. I think the two are quite close to each other. But now, I don't know, because the cycle does look different from previous cycles. We have this extended, so we never went down, right? Remember, we talked about this bimodal behavior. We only went down one time, and we basically stay there. And when I say down, relatively to the power law. So because usually when we go in this bimodal mode and we go above the power law, um, this bullish mode, we stay there. We stay there for 1 year going up, and then it takes another year from the top. So we stay above there for 2 years. It was one instance, I think 2 cycles ago, where we went down very quickly, and then we bounced back above the power law. It happened once. Now we are spending relatively long time below the power law. It has been more than 2 weeks, 2 or 3 weeks. So that is anomalous. It never happened before. So, right, nobody has the ability to predict the future perfectly. All what we can do is to talk about these general trends, or compare the cycle and say this is similar, this is different. And like I say, is quite different. Now, is it different enough where we can conclude that we don't have a cycle this time? We don't have a bullish behavior. We are above the support by quite a bit. So in a sense, it's bullish, but it's not as bullish as we were thinking. I'm still targeting the 200K, because until we have enough of a signal that say, no, the 200K is not going to happen, I'm going to stick with it. Now, as we come closer and closer to it, it's going to be more and more difficult. Right now, for example, I just made a calculation. If we started today and we reach the 200K, we will need about 0.3% a day compounded in average, like exponential growth, 0.3%. Now, 0.3% is not unsustainable. It's an okay type of return. Like last bull, for example, we were in average 0.42% a day. So it will be actually a performance that is less than the last bull run. So it's still doable. By the time we go to June, we will need more like 0.5% a day. And that starts to be relatively difficult for Bitcoin to do that on a sustained manner, right, for many, many months continuously. And, because we will have some bad day, we will need to have 1%, 1.2%, 1.5% a day. It is really incredible, right? Of course, we had days where we went up 8%, down 8%, but I'm talking about in average doing that for a sustained period of time. So I think by June, probably we'll have a good idea if we go back to a bullish behavior, or if something else is happening, and maybe this idea of cycles needs to be abandoned, or at least this time, we're still kind of in a different territory, but not yet where we can say that the cycle is not going to happen like we expected, right, with a certain target and so on. This is my opinion. What do you think,
Well, I tend to agree with the comment about June, us getting more clarity. by then, because we've got to get through the uncertainty around the tariffs and the budget, and so that has to settle down, and then the Fed has to move, and they're waiting. The latest inflation number wasn't too bad. So, but I think more things need to happen before the Fed feels like it can move, and that's kind of what we're waiting on. It depends on Chinese liquidity and U.S. liquidity as the biggest two factors. Uncertainty here, but private liquidity has picked up. That overall has actually turned up, in part because of private, in part because of the Chinese. And so the lag should be kicking in. Now, Q4 was very bad, but liquidity picked up during Q1. And if the lag really is 10 or 11 weeks, then it should start kicking in. I think this question about will the top be 150 or 180 or 200 is not quite the right way to think about it. I think the right thing to think about is when will the bubble happen?
Right.
Or if it will happen. Because I think we can get to 200, but it may be delayed if the Fed is delayed, right?
Yeah, and this is the next question. Basically, we're asking if you are thinking about a delayed peak. Now, what again? I think is we can make these considerations, right? We observe this correlation between liquidity and price. So, and we are seeing the liquidity increasing. Most of the liquidity increase is not including US. So by the time US joins, because I think it's almost unavoidable that there will be some kind of injection of liquidity from the US. And when that happens, right, now we will see an increase even higher. So is it going to happen? Probably yes. The question is when. Now, as I'd said before, a scientific approach to this understanding of a cycle is mostly saying, given that something happened many times in a certain fashion, is what is happening now similar or different, right? How similar, how different it is. And, I have indicator where I do this one-to-one comparison. I can show you exactly how it looks like. And let me do that. And it does look different, right? Like I just said. Just give me a second. Okay, so this indicator compares the different cycles, right? And here you see this is the current cycle. You see how we are going below the power law, right? The previous cycle, it was anticipated mostly because I think the right interpretation was it was a lot of stimuli after the COVID. This V is the COVID. Let me see here. This is the COVID, and there was the stimuli that came out of it, and people were investing in the stock market, in Bitcoin. So we had an early top. We had two tops, this top and this top. Right? You see here I'm superimposing the different cycles, one over the others, so you can compare them. And if you go to the previous one, we were slowly, this is almost like a textbook example of what the theory says Bitcoin should behave, right? This 1 year up, 1 year down, and then 2 years along the support line. And then as the bull market starts, we leave the power law and we go towards the top, right? This was almost a perfect example. But notice we were not even crossing the power law because it started, close to the support level, while we were already very close to the power law. So when we crossed it, in a sense, one possible interpretation is, this one had an early peak. We are not seeing an early peak, and because of there is not enough injection of liquidity, whatever. And the reason why we are stuck there is because we kind of anticipated, due to the ETF, the bull market, right? And then there was a correction because it was not happening at the right time. The correction was not big enough. This correction that happened last time, when we had something similar, where we, for whatever reason, we went above a power law, right? Stephen calls them fake outs. It took COVID to correct all the way to the support, and then we started from there, and actually we anticipated. In this case, everything was smooth. We never crossed, and so it takes time before we go above the power law. So maybe, in a sense, this is kind of an average between these two. They all have their own personality, but this is not anomalous enough to completely exclude that we continue and we go there, right? It's still in the realm of possibilities. So it does look different, right? And here you can see a better picture of this, right? Because I'm detrending and taking out the power law. You can see there is a clear growth during this period, right? This is the year where we go up. This is the year where we go down. This is when we stay flat. So this pattern has been repeated over and over, where if you average over all the different cycles, it looks like there is a precise pattern, right? 1 year up, 1 year down, and following the power law for 2 years. And right now, we are doing something different, and maybe because, it's still trying to figure out what is going on, right? And when we have a correct liquidity, then it will still be there, like an overall growth for 1 year and then going down. So I will not exclude it. It's just it looks different. And so all what we can do is to report the similarities. Initially, it was almost perfectly following the previous cycles. And now, for some time, we just follow basically the power law. And then now we are correcting. But, the question is, are we going up again? We don't know. We can only compare what happens now with what happened before, and notice the similarities and differences. So the height, I think, if we go back to kind of bullish behavior, by power law alone, by the end of a year, if we stay along the power law or just above the power law, by power law alone, we should be 130. So it's not unthinkable we go to 150 or even 200. Now, as time passes by, different scenarios start to be unlikely, right? For example, I think right now 500K is probably excluded as a scenario. 1 million, that some people even call a 1 million Bitcoin by this cycle. You can see how ridiculous that statement was, right? I think it's almost impossible. I don't see that happening. 500, quite unlikely. 200, no. It's still in the realm of possibilities. So yeah, this is how you have to think in terms of what is likely, what is not likely. What is the returns? I think one of the best ways to think in terms of returns. What are the average returns that are sustainable over a relatively long period of time to achieve that goal? 200 is achievable. Okay. Now the delay, again, if you compare with what happened before, it never happened. We never had a peak that went beyond Q4 of that year where we were supposed to have a bull run. Now, does it mean that it will never happen? No, but we had 3 different bubbles, and it never happened before. So it will be different, if we have a quarter 26. But it's not impossible. Maybe this is, it could be close enough, maybe in January, February, where statistically it's still around, because, okay, we had 3 times where it was before. Now we have a time when he's later, and in the future it will turn out to be still around the same area, right? This line that I draw here, but sometime happened before, sometime after Q4. It's 3 dots is very little to do statistics. You cannot you can try to find a pattern after 3 dots, but it's not enough. Okay, so the next question. Do your models take into account the impact QT, QE, or interest rate have, the time last cycle rating? Do you want to answer this question?
Well, none of the models that I presented in the last few weeks. It's only implicitly in the behavior of the stock market prices when we compare to those, because those are reflecting interest rate policies and quantitative easing policies. But there's no explicit taking into account.
So, people, this is something that finance people do. In fact, this is kind of what we saw last time when we were discussing the article in Forbes that was talking about the power law. They want to associate something, and it's not that physicists don't do that, but we do it in a different way, right? They start with these very abstract concepts, and then they try to tie it to observables, like the price, for example. And many of these models fail because there are 2 or 3 layers of basically making up stuff. They are trying to make up some kind of a model that somehow is really, if this thing happens, then these other things is happening, etc. Physicists many times do the opposite. We start with an observation. We try to understand the pattern. We try to characterize. We try to separate what is noise from signal. And then maybe after that, we are trying to find some kind of a causative link. But most of the time, we avoid to do that unless we have a clear idea of what that causative link is. And many times, it turns out to be, like, for example, I was mentioning last time how when Kepler's law was found, it was explained by Newton with the law of gravity, but it turns out the law of gravity is another power law. So basically, you find something that you think is deeper, but it's basically another pattern. And so in our case, is the closest thing that we come is hash rate, for example. We are saying there is a relationship between hash rate and price, addresses and price. But of these other economical things, besides saying, oh, we are correlated, not correlated, I don't even feel good to go in that direction. It's more like a philosophical approach to this kind of stuff. What is your opinion about this?
Yeah, it's, we try to strip things down to their essentials.
Yeah, exactly.
Yeah.
And so this other question, market cap, 66 billions, 20 billion value.
He's asking if the multiple is going to go to 1.0. I think not. I think that, Saylor has built a Bitcoin refinery or a Bitcoin bank, and he has many ways to financialize the asset. He can issue convertibles, which he's done. He can issue preferreds, which he's done. He can issue equity, which he's done. He can issue conventional debt, which he's done. And he can leverage. And so, to me, that deserves a substantial multiple. I can't tell you what it should be. Right now, it's 1.86. 2 is not unreasonable. There are some people who think, it could go to, and it has been above 3. There are some people who think it could go to 5, based on, extrapolations of market price, which I don't buy into. I don't think it goes hyperbolic. I don't think you get to a point where Master is worth more than all Bitcoin if he only has, 500,000 or even 1 million Bitcoin. But I think he can get a very substantial multiple. And it depends on execution, and it depends on, the demand that comes from FOMO. When Bitcoin price goes up, his multiple is going to go up. And I don't think it's going to drop to 1.0. Yeah.
If anything, I think it will be stable over time. So probably the 1.3 factor that we found, that power, it's like a power law of 1.3. This is how it looks like.
Mhm.
It's because there have been times where MicroStrategy was becoming exponential, and it was kind of disconnected almost with Bitcoin price, but it was mostly, I think, crazy speculation, and then it corrected, and it's going back to this original power law that we found with both me and Steve found between MicroStrategy and Bitcoin. So this question is about, so does it mean that it's better to stay with Bitcoin versus MicroStrategy? What do you say?
Personally, I have some master, and that's because I've done, the Kelly analysis. This was somewhat surprising to get a 100%. I'm going to play with the weighting and see if that moves around with some different weightings. It's all a matter of your risk posture. How much risk do you want to take, right? I would not recommend going above 20%. So of your total
Yeah.
Bitcoin, if you want to slice off 20% for master,
Yeah.
I cannot find fault with that based on the Kelly analysis. I certainly am not a fan of 50-50.
Yeah. And so that is actually a very good conclusion, right? Because I think hodling is the way to go, because all of us are hodlers, at least up to a point, right? So my idea is that you could take always 10-20% of your portfolio and do a little bit more aggressive things, still related to Bitcoin, because at this point, I don't know, and maybe this is my worldview that it has been forged over 12 years of dealing with Bitcoin. I don't want to. I have seen one share of NVIDIA. This is all what I have, and everything else is I beat. I for mostly because it's easier for me to do an IRA. You can do IRA with Bitcoin, but it's easier to do it with IBIT. I can do it on my Robinhood or whatever. I have some MicroStrategy, and I do even trading with part of my holdings. I buy futures and things like that. But you can do that with 10, 15, 20% of your portfolio and try to do a little bit more aggressive things. You can learn to do options. You can sell some of your Bitcoin if you come to a top and then try to rebuy at the bottom. But don't risk more than 15, 20% of that. Everything else should be in a cold wallet. You should not touch it. Do hodling. This all, right? And you can do it. You can arrive to this conclusion by common sense, all the beautiful mathematics that Stephen has shown us, But the conclusion is always kind of similar, right? We arrive to the same conclusion. And it's perfectly fine. So if you want to do 100% hodling because you don't have time, etc., that is fine. But I don't like when people attack me or us in general, when we say, why don't you do also something else? Because you can learn. First of all, it's a learning experience. You learn how to maybe some new concepts like Kelly criterion or other things like this, and maybe learning how to buy and sell options, etc. And maybe if you learn and you're good, you can make some extra money that you can use to buy Bitcoin and so on. So that is it's very reasonable approach. They're asking me about sending the equation. Okay, I will post how to do this in our Discord group. No problem at all. Are cycle a prerequisite of a power law? Do you want to say something about this?
No.
So I want to elaborate about this. I think the power law is the fundamental phenomena, and then so in a way the bubble do not exist, because if you look at this graph, notice how we leave a support, we reach a peak, we go back to the support. So in theory, it's almost like if they cancel, and you can find out this also by averaging the price over 4 years. It looks like it's almost perfectly approximating the power law, and is approximating more and more of a power law. Now, they do exist. So we also need to explain them somehow, right? And one possible explanation is that they are related to the power law. There is all this work that, that is called the log periodic power law by Sornet that explain that bubbles are related to power laws. This is why it's called the power law, log periodic power law. And there are reasons for that, right? And it's one of the things that we are exploring. So it's possible that in the end, there is some kind of interconnection between the fundamental phenomena and then these moments where the price deviates from it, but it looks like something additional, but actually it's in a certain sense a variation of the theme. Stephen, if you look at some of our previous episodes, describe it as additional turbulence, right? So it's not that the physics of a gas changes when it has a steady flow and it goes to turbulence. It's the same gas. It's just that the condition. So when you reach certain critical velocity, when you're reaching certain densities, etc., the condition changes, but we are talking about the same type of phenomena, just in different regimes. Is this one way of thinking about this?
Sure. So just to elaborate on why I said no, that the cycles, or to be more precise in our language, the bubbles are confounding, so it's really power law plus plus, it's power law plus plus bubbles. And then we need to sort out, what the bubbles are doing. The bubbles do not create the power law. The power law is based on long-term adoption and the network effect. I think the bubbles do help with the waves of adoption, but then price always comes back to the power law cores. We've shown very, very clearly. So if you think of it in the fluid analogy, it's, as Giovanni just mentioned, it's as if you have a flowing river or, an ocean, and it's got laminar smooth flow. Sometimes it's turbulent. Sometimes you have big storms and then they go away. The river's still there. The ocean's still there. It's still flowing. It's still obeying the laws of physics.
Yeah.
So the power law is fundamental. And what we're seeing is that the volatility is coming down. The cycles are not as strong as they used to be. And, the whole thing is becoming more and more stable, but fortunately, still very strong growth.
To answer this question, I know how to answer in a different way, but let's see if we can. Do you want to answer it?
I have not calculated it. But if the price goes up by 2.5 times, and it would be around 650, and I would expect that you'd have multiple expansion. And right now, the multiple, according to Michael's webpage, is 1.86, and that could easily go to 2.5. So 1,000 is quite reachable, I think.
Okay, so my calculation is slightly different. So what I do, I take the ratio between 200 and 84, whatever it is, the price right now. Then I raise to the power. So I'm not multiplying. So this is one of the confusion. So if it is true, right, we have little data. So when we say, oh, there is a power law, etc., you have to take it with a grain of salt, because really a true power law is established over many, many order of magnitude. But if it is true that there is a non-linear relationship between MicroStrategy and Bitcoin, and is a power law, then we take the power. We don't multiply, we take the power. So it's 200, you do it in this way. You take 200 divided by 84, right? The 200,000 divided 84,000. We can eliminate the zero. You take the power of 1.3 and then multiply by the price of MicroStrategy. And what I get, it's $800, 809 to be precise. Mm-hmm. So let's see if that, but you come close to basically $1,000. But I would say $800. That is the prediction if we go to 200. And this relationship stays. It's possible that during a bull market, everybody gets excited, and then this relationship changes and it becomes steeper. People are even more bullish with MicroStrategy because it's about leverage. Like kind of what happened when Trump was elected. MicroStrategy started to go crazy and they started to go exponential. But if he follows this balance proportionality, then it will be $800. Okay, maybe we can take one more question. And here, similar question, but now when Bitcoin reaches 10 million, what do you say? So I don't think it matters, but what do you say?
Yeah, no, I mean, I already answered it. It's going to get a premium. In fact, right now it has more uncertainty than it would have in that situation, right? So in some sense, a premium would be more justified. That doesn't mean it would be larger than 2 necessarily. I don't know what it'll be. But the fact that it would have a premium once it has 1 million coins and once Bitcoin has a market cap of 20 trillion, 200 trillion, it would be very justified in having a premium because it would be an enormous Bitcoin bank in a world where the value of all Bitcoin would be comparable to the value of all global M2.
And that, and again, if it stays non-linear, so it's not just a multiplier, but it's a power, and that power is 1.3, that is what we measured before, we go from 100 pair for Bitcoin, so we go about 100 pair to 10 million, roughly, right? Let's round it to 100K, being close to 100K. So we're talking about 400 pair for MicroStrategy. So Bitcoin goes up by 100 pair, MicroStrategy goes up 400 pair. So this will be the difference between the two. But it is reasonable, right? So it's still something that is achievable if Bitcoin goes up 100 times. Anyway, guys, I think we covered a lot of topics. I think it was another very interesting episode. We will continue to explore. I'm going to talk with Stephen about what he was trying to show me about the asymmetry in the autocorrelation function. I think I understand what he's saying, but I'm going to explore that more. It probably means there is some kind of a spectrum of different lags. That is not just one single lag, because one single lag will look like one single peak. But if there is an asymmetry, means there are several. But yeah, we can explore that. Maybe we can calculate an average lag that works best. Yeah. Okay. Thank you so much, guys. See you next week.